video's recording is back on. I want to talk about Ford's as is, if you went through the process. So basically, you should have put in Ford's data. WAC, when I did this earlier today, was around 7%. Shares outstanding, 3.9 billion. 12.39 was the share price when I did this a little bit earlier today. Your numbers might be slightly different. Those were the multiples based on the 12.39 share price for EV to revenue, EV to EBIT for the out years. Those were the growth rates, revenue, EBITDA from the EEOs. And over here in the ratios, tax rate, again, they were giving guidance. So JP Morgan, 24.9 seemed reasonable. Using the perpetuity, operating margins somewhere between 6 and 6.7%. I used 6%, which suggested an EBITDA of 10.8, and then basically needed to solve for a G. So the 0 is a placeholder. I didn't put the solver in yet. So what G's did you guys get? Assuming you have numbers that look probably somewhat similar to that. What G did you get for Ford? Yeah.
Negative 98%.
Okay. So they're going to shrink 98% a year? Is Ford going bankrupt tomorrow?
Looks like it.
Well, negative 98%, it sounds like they are, but does that, back to the smell test, does that seem reasonable?
No.
Okay, so we know 98% negative is probably not a reasonable G for Ford. Yeah.
I think the revenue number for 2023 is off. I think it's 152 instead of 62.
For 2023,
Yeah.
I could have easily transposed this wrong, so let me go back to Ford. EEO. 23 revenue, 152,594. Oh, so 162. I don't think that's going to solve our problem. But thank you for helping me correct that. So back to G's. What's a reasonable G for Ford in perpetuity? It's not negative 98%. So what should we use? And by the way, if we use a 0G right here, then we get a share price of like $19. Their share price is $12. So what's going on with Ford? So let's walk through. WAC, 7%. I don't think that that's unreasonable. Okay, so I don't think, unlike Amazon, I don't think we really need to adjust that WAC. So then tax rate. I don't think we need to adjust the tax rate. 24% tax rate seems pretty reasonable to me for a U.S. company. So I don't think the tax rate is something that's going to be dramatically different and much higher. All right. One thing that is a little bit higher than historical numbers is what those trading multiples suggest that EBITDA margin needs to be. Almost 11%. And they've never hit that number historically. Matter of fact, pre-pandemic, their EBITDA margin was around 7 to 9%. And even with improvements, it doesn't get up to 11%. Okay? So that would be the first thing. Like, I'm not so sure that that's the right EBITDA margin / ROIC that would come out of that. Okay? So there's my challenge. All right? I think that the trading multiples are broken, which we're going to come back to in a minute, and don't really give me a realistic EBITDA margin for Ford. So, but if I don't come up with a realistic EBITDA margin, it's going to be hard to figure out the growth rate. Okay? So here's where we're going to go the other direction. Right? If you actually look at the Ford growth rate going forward, like a couple percent, 1-2% most years, 4% in one of the years. But I think Ford is a mature company. Unlike Amazon, it's not going to grow 10% a year. Okay? So Ford growing 1 to 2% a year, kind of going with the economy, I think is probably its long-term growth rate as a mature business. So the reason why we had followed the process is the assumption I was telling us to make is the ROIC slash margin was stable in the future, we could estimate the growth. But since the ROIC margin's in question, and I think the growth is less in question, maybe we should set the growth and then estimate the margin. Go the other direction. Okay? So here's the point. If I make my growth, and I'm going to put in 2%, about 2% a year, okay? Just straight grow with a slower U.S. economy as a mature company, all right, which is pretty much what they're going to do for the next 5 years anyway. So I think that's more of a perpetuity growth number, 2%. What margin solves for that share price? So what I'm going to do is I'm going to go back to my ratios, and the EBITDA margin, M7, I'm going to use goal seek on that. Okay, and I'm going to solve for what margin at 2% gets me the share price, as opposed to saying at what goal growth I need at a 10.8% margin. So here's what I'm going to do. Tools, goal seek, set cell, share price, D30 to, what was the current share price? 12, what? Remember the number? 12? Yeah. I think mine was 36 this morning. Whether it's 60 or 36, I think it is what I had. It's not going to matter much. Yeah. So here's the point. By changing the margin, and that's going to give me a margin of 8.9, which is, by the way, pretty close to where the analysts expect them to be in 26 and 27 anyways. And if I use that as a perpetuity margin, then my share price is pretty close to the current share price, right? So that's my point. Like, in this case, I'm going to go the other way. I'm going to basically say, I actually think I can get a pretty good handle on the G. What would the margin be? As opposed to, I have a good handle on the margin for the multiples. What would the G be? Because I don't think that margin made sense. I think it's too high, right? Because given all the struggles that Ford has been having, and you start reading through the BICO, they're having challenges. They're having operational challenges and other issues. And just with getting electronic vehicles into production, I don't think that Ford's going to get that growth. I don't think they're going to get that margin improvement. I don't think the market does either, which is why Ford is trading at such a low multiple and to some degree explaining the share price. All right. Now it's interesting, just to kind of support the narrative here, if I go to the ANRs, the buy, sell, hold opinions of the real Wall Street analysts, okay? 9 buys, 12 holds, 5 sells. But if I look at their target share prices, the low target share prices of the people who are calling them a sell are like $10 or $11 a share, which is not too low compared to much lower than the current share price. And so the point is, if you think about this, Ford is trading at an EV to EBIT multiple of 4 today. That was the multiple set, which means I can buy the entire company for the next 4 years worth of earnings. Well, that's not a long-term future valuation, okay? Remember I said for most companies, 80% of the valuation is the continuing value. For Ford, 100% of their value is coming in the next 4 years. They're the exact opposite of most companies, which means the market is not ascribing any long-term value to Ford, if you really think about this. That's why that trading multiple is so low. They're basically saying they can make all their money, the entire value of the company is the next 4 years worth of profits. That's what the EV to EBIT multiple is telling us today. There's zero value long term. Okay? So let me understand, what would make a zero value long term? That means that growth has no value. Well, if growth's going to have no value, that's growth at no spread. So the point is, the way Ford is being valued today is growth at no spread. Okay, that's what the multiples are telling us. If you just kind of think through conceptually about a 4 times multiple. Or so it's either growth at no spread or growth at a slightly negative spread. Well, here's the point. If I make my EBITDA margin what I did, which was around 8.9%, that's an ROIC pretty close to their WACC. And that's the whole point. I think that's the way that Ford is being valued. That there is just no long-term value that the market is ascribing to it in the as-is. Okay, I could disagree with that. Right? Some analysts do. That's why they're putting them at 20. They're basically saying they're going to be worth more than 4 times earnings. So that's why they're probably putting a buy on them. But there's still skepticism about that, which is why Ford's not trading at that price today, right? But nonetheless, does everybody see how we're kind of arriving at this? And by essentially using the growth to infer the margin, as opposed to the margin to infer the growth, that would give us a better understanding of what's going on with Ford. And it also goes to the point I made earlier, we were talking about Amazon, that you got to apply common sense to what you're trying to create. And this one was just more obvious because you couldn't get a G that worked. Like none of the G's made sense. Okay, and so how do I come up with a more realistic G? Sometimes I might actually put one in there and see what happens, as opposed to try and solve for a G. Nuances. Art evaluation. Questions? Yes?
How did you determine if the WAC is unreasonable?
Well, again, another way we can look at it. So let me go here to Bloomberg. Let's go to BRC. What I did with Amazon, so let's do this for Ford. And I'm just going to see what JP Morgan is using for a WAC. It seems like it found a WAC for here. So they're using a pretty high WAC. So that would be the other argument, is you could make an argument that the WAC should be much higher, which is what JP Morgan apparently has done. Okay? But here's the point. If I go to, again, RV, markets, beta, the automobile industry, which is represented here, is already at an industry beta of 1.3, 1.28. Right? And Ford is already at 1.59. So I don't see a situation where Ford, as the market, goes up, gets 50% more in sales. And I don't see as the market goes down that they get 50% less in sales. So I'm just saying, to get to a 13% WAC from a 7% WAC, I mean, your beta is going to have to be 3. I mean, it's going to have to be gigantic. And I'm not saying that they haven't had some volatile swings in the time of COVID, but again, back to the smell test, I'd have a hard time explaining that high of an extreme beta in a DCF valuation. All right. And I'm not saying that JP Morgan doesn't see a lot of risk in Ford, but that'd be the point. I'm going to put the risk in Ford on the fact that I don't think they're going to get the margin or the growth, as opposed to I'm just going to use a high discount rate. All right. Now, some people go the other way and say, well, I don't know what the growth of the margin is going to be, so I'm just going to give them a very high discount rate and just throw the baby out with the bathwater. I think that would be what JP Morgan would be saying if they put that WAC that high. But I'm just saying, for the typical automobile maker, I don't think the WAC's that high. Right? So I think the real problem with Ford that all this is getting into is there are problems with Ford long term. The market is very worried about their long term, and that's what's showing up in their current share price. And that's the most important part of the as is. Now, the way that I'm getting there might be a little bit different, but I'm just saying, to me, I didn't see a big need to change their WAC. I saw concerns with the growth and the spread. So low growth at no spread. That's the valuation that I would have done for my as is. Right? Not saying I'm 100% right. You guys can make some arguments, but that's the point. You're going to have to do something. You can't just use the plug and chug to answer the as is for Ford. Now, when I did put this as is together, I would say 2 things. One, when I did my bull and my bear, ironically, I would say that we did Amazon had more downside than upside. Meaning, my interpretation of the as is for Amazon, if I were doing a bull and a bear, is Amazon's already kind of priced to perfection. Meaning, they need a pretty high growth rate into perpetuity at a reasonable margin at their scale to justify the current share price. And that's already built into the current share price for Amazon, which means I actually think there's more downside risk to Amazon than upside if they don't hit that growth. And there are already some signs that they may not be able to hit that growth. Okay, so That's what I'd be worried about with Amazon. Ironically, with Ford, I actually think there's more upside than downside, meaning they're worth the next 4 years of income and that's it, which means the market's not giving them any long-term value. So the worst case scenario seems to be playing out in Ford's stock price today. And if they can create any value long-term, then there's actually a lot more upside to Ford than downside to Ford. So that would be the point. Ford's bear actually might be closer to the $9, $10 range, unless they go bankrupt, which I don't think they are. Versus upside, you could probably get a much higher share price, again, 15, 20, if they can actually get to a reasonable margin or a little bit more reasonable growth rate. So my bull might actually be higher for Ford, and my bear might be a little bit not much lower than the current price, because I actually think the current price reflects a bearish scenario. Where Amazon's the exact opposite. I actually think the Amazon scenario, the current price reflects a little bullish scenario based on what we just did for the as is. Now again, you might disagree, but that's the point. You got to write up the changes, the assumptions, go through that part of the model, come up with the target where you think it's going to be. But in order to do that, we got to continue to do realistic as is. Again, questions about any of this. This is advanced. It's not easy because, like I said, just when you thought you figured it all out, we got to actually do some more thinking, but that's the point. Regardless of the class, real world, you should always be looking at the data that you put in, questioning assumptions, thinking about what you're going to get out. Garbage in, garbage out. Okay? And just because you can solve for an equation doesn't make it so. Matter of fact, we're still going to have a problem with Ford. Because if I go back to the idea that we should be able to explain with this the trading multiples, where's Excel? Given that they're trading at a 3.98, 3.56 times EBIT and a 0.24 EV to revenue, I can't come up with a reasonable G. Try using GoalSeek that explains those multiples. I just can't. I'm either going to get a big negative number or I'm going to get like a 15%, which it can't work because it's way above, because there's multiple answers that solve for that G. But the point is I can't actually solve for the current multiples. So again, I would just call Ford a broken company. They're being traded like they're a broken company. And I think what's broken about them is people just have serious concerns about them as an automobile maker long term, and they're just throwing the baby out with the bathwater, and the buy side is just avoiding Ford because they just don't ascribe any long-term value to it, right? And I think that's what's playing out in the marketplace today, right? And they have to change that perception before the value is going to change. And they're not doing anything to actually change that perception yet. The market is just being very skeptical about their results, okay? So they can change that perception. They can actually make themselves better. There's a lot of upside in the Ford, okay? But nonetheless, I can't even explain the multiples. Now, given the DCF, I'm still comfortable with a 2% growth rate, right? Because even if you went 1-2%, you're still not going to be able to get a multiple low enough. Because if I did this here, at a 0% growth rate, well, it's here, 0% growth rate, I get a multiple of 10.7. So if I did a negative 5% growth rate, I'm still not getting down to a multiple of 4. So I'm going to just tell you that you're probably not going to be able to explain those multiples, other than what I just said, that the concept of there's zero value long term if I'm being traded at 4 times my current year's earnings is basically what the market is saying about Ford. That's the closest I can get to try and explain it. These were not easy. That's why I chose them. It's easy to do a Costco. It's easy to do a Walmart. It's easy to do a Procter & Gamble. It's easy to do a Clorox. Some companies are less easy. This was an example, too, that we just did today, and maybe the next homework assignment. Homework 11 is on Royal Caribbean Cruise Lines. Okay? I want you to value them long term. And I will warn you that when you get to them, you're going to notice their tax rate's 0. Okay? That's actually true because they're headquartered in Liberia. Now, they're actually headquartered in Miami, as is Carnival. But this is our crazy, stupid U.S. tax law that says if you're registered in a foreign country as a cruise ship, we will allow you to use that country's tax rate. So both Royal Caribbean and Carnival convinced the Liberians to let them have a P.O. box there. and all their employees in the United States and take advantage of Liberian tax rates, which are 0. So this is our crazy tax rate. You want to fix our tax rates? Fix stuff like that. Okay, that's the whole point about people paying their fair share. Anyways, it's 0, and unfortunately, it's not likely to change anytime soon. So just giving you a heads up as you're doing that valuation. Wednesday is a lab day. I'm giving you the lab day to work on Royal Caribbean, no lecture, and to work with your teams on Nokia. Start working on that for 2 weeks from today. Next time we'll be together 1 week from today. Talk about Royal Caribbean. We're gonna start multiples. Okay, see you guys in a week.